All right. Welcome, guys. Income Navigator. Today is Friday, January 26th, 2024. We got a couple of things we want to talk about. Mainly, we're going to go over positions that I am holding. And if you guys have any questions, there's a chat that you can ask questions. We'll try to answer all of your questions, but I'm going to go through my positions and um, share my thoughts, my process, my thinking, and what I look for in certain trades, what I look for, and how I'm going to manage these trades. And hopefully, this will give you an idea about how I um, approach trading from my point of view. And hopefully, you'll get some value from this. So right now, what I am sharing on my screen, and let me know if you can see my screen. I am sharing a spreadsheet. I share this in a Discord. This is Income Navigator Trade and Portfolio Tracker. I have several tabs here. I have two separate accounts that I'm going to focus on. This is both accounts are with TD. One is a PM. One is span margin. We're going to start with the PM account. This is where I mostly trade XSP11X. And when I say 11X, this is because these trades could be 112, they could be 111 or 113, different variations of the same or very similar trades. And I'm also going to share my option at Explorer to show you what the risk graphs look like for each one of these trades as we move along. So today, the 26th, we have a couple of positions. We have 1, 2, 3, 4, 5, 6 positions that are currently open. And if I scroll over to the right, this kind of gives me an overview of what I have going on. So I have 6 open positions. I have 1 position that is closed. And in total, so far, there are 7 positions that have been taken in this account. 1 position that was closed was on the 19th, a small gain here. And the next expiring trade I have is going, has 5 days left, right? And I have a column here that tells me how much time I have left on the trade. This is the next expiring trade. And the very first column is the trade ID. And this is something that I find useful for me. I pulled this information from Option Explorer. A trade ID will help me find the trade. And if you are looking for the same trade, you can go to the trade alerts channel on Discord, and you can just use the search box to search for the trade ID, and then you'll be able to open that trade up and kind of go through all of the adjustments or any changes or any comments or questions that were as part of that trade, and kind of it'll help you get an idea about what's happening within that trade. So the trade 2770, this is an XSP. This was a 5 lot expiring on January 31st, which is in 5 days. And I am going to share my Option Net Explorer screen so that you can see what that trade looks like. All right, so here we can see that this trade is kind of simple, if you will. Let's look at the price chart. It looks like there was only 1 adjustment. And, just looking at the risk graph, I can tell that I have a leftover put debit spread that's expiring in 5 days. All I did was I put the trade on. I took off the naked short puts, and this left me with My max potential reward here is the leftover tail profit, which is probably what's going to happen in this trade, unless we pull back, in excess of 10%, and that's where this put debit spread is really going to pay off. Very unlikely, but this is what this trade looks like. I'm going to do nothing else to it. Just going to kind of leave it alone. And um, what's going to happen is all of the options that are part of this remaining put debit spread, which are currently going for the 450 put that I'm long is at 3 cents. The short 445 put is currently going for about 2 cents. So this is very likely to expire worthless, which is totally fine. And all I'm going to keep is the remaining credit that I collected in this trade. I'm going to go forward to the next trade, and you can see that in the option Explorer, I have all of my trades here listed. So we're just going to go to the very next one, which is the March 15th. This is the trade that was put on 45 days ago. We can see that the underlying index, which is S&P 500, has moved just over 1.5 standard deviations from where this trade started. This trade started on December 12th, right? We kind of had an up move, down move, up move, down move, and now, we're in a pretty decent uptrend still. So what happens here is that, as we know, when we put on 112s, one of the potential outcomes is that if the market rallies, we're going to make the tail profit, which is fine, right? And if the market pulls back and we end up somewhere between our put debit spread that we're long and the naked puts, we'll make the bear trap profit. We're not there, clearly, since the market has moved 1.5 standard deviations to the upside. So here we have 49 days to go. And we can see right now, this position is up just about $240. And it's very likely that this trade is going to expire for a full tail profit. And when I say it's very likely, what I use to gauge the likelihood of this trade expiring for the tail is I'm just looking at the delta of my long leg of the put debit spread, which is currently at 455. And we can see that the delta of the 455 put is about 10, which means that there's only about a 10% probability that 455, which is the long leg of this put debit spread, is going to be in the money. This tells me that there's about a 90% chance that 455 put that I'm long is going to expire out of the money. And if my long leg of the put debit spread is going to expire out of the money, that means the remaining legs or remaining options that are part of this trade are also going to expire out of the money. So there's about a 90% probability, implied probability right now, that we're only going to capture the tail profit or the credit that we had collected upon entry. Looking back at the chart in the option Explorer, I can see that there was only one trade that took place here. There was no further adjustments here. So I'm just going to let it kind of simmer. If we do see a pullback in the next 49 days, maybe if the market goes down 10%, this is really going to pay off, but very unlikely. And this is a very typical 112 in a strong uptrending market. Right. So the goal is to build a portfolio of trades that do not keep you up at night, trades that you don't have to look at, every half hour to see what's happening with the trades. These are very boring, very slow cooking, but over time, if you capture enough tail profits, it's going to show a decent return on the investment or on risk that you are taking within these trades. So this trade has 49 days. I mean, there's still a lot that can possibly happen. And one way I look at things within the option at Explorer is by looking at what is currently being priced in based on today's implied volatility. And we can see that this darker gray area is a one standard deviation move from today's price. So if we move down one standard deviation, I'm still not anywhere near the bear trap. In order for this bear trap to kind of come into play, we would have to move about two standard deviations or more from today's prices over the next 49 days. And as we know, right, the probability of a two standard deviation move up or down is only about 5%. So it's very unlikely that we're going to hit the bear trap, and I'm totally fine with it. We knew exactly what our max potential reward was before we took the trade, and we're just going to let it sit and let it do its thing, and we'll see what happens. I'm going to move forward to the next trade, which is March 28th. Very similar scenario here, a little bit more time on the clock, 62 days to go. We've been in this trade for 22 days. The market moved, or the S&P moved, about 1.4 standard deviations to the upside. Again, looking at the chart, we're in an uptrending market. No adjustments have been made to this trade, so we're just going to let the time run on the clock. 62 days, a lot can happen. Let's look at what can possibly happen over the next 62 days. And again, this is all based on today's implied volatility, and we are in a relatively low implied volatility environment. But from what we can see right now, if we move down one standard deviation over the next 62 days, we're still not hitting the trap, which is fine. If we move down two standard deviations over the next 62 days, we are potentially hitting something inside the trap, which is good, as long as we don't move a lot more than what the market is currently pricing in. If we move more than what the market is pricing in, this trade has a very good potential to make the bear trap profit. And if we move way more than what the market is currently pricing into the downside, and implied volatility is going to pick up, this trade could potentially get into a little bit of trouble. But based on what I'm seeing right now, it's very unlikely. And again, we can go back and look at the delta of the long leg of the put debit spread, and right now that delta of the 465 put is about 18, and that tells me that there's only about a 20% implied probability that 465 put is going to be in the money at expiration, which tells me that implied odds of 465 being out of the money is about 80%. So there's about an 80% probability that we're just going to capture tail profit, and that is totally fine. Let's move forward. Next trade is April 19th. This trade was put on 17 days ago. Very similar, uptrending market. Really not too much to add to it. We're just kind of – trade is slightly profitable, and This is something that I wanted to talk about a little bit. And let's dive into this. We talk about using net Greeks to kind of dictate when we should put new trades on, right? So, for example, if you look at your overall portfolio and if you're neutral on your net Greeks in your portfolio, and that signals that you need to add more positive delta to your overall positions, it doesn't necessarily mean that you should be adding trades like 112. And I'll tell you exactly why, right? Because in the last couple of weeks, maybe 3 weeks, I've been putting on trades that had positive delta to start with, and the market has been moving higher. This is a perfect example, right? 17 days ago, I put the trade on that had positive delta, right? And the market has moved higher. As we can see, we've moved 1.33 standard deviations to the upside. And you would expect a trade like this to be a lot more profitable than what it is currently showing us. But we aren't seeing what we would expect to see. And this is because when you look at your net Greeks, and if you think that adding a 112 that starts off positive delta is actually adding delta to your positions, that is not the case. The reason being is because we are not talking about raw delta when we look at trades like a 112, right? A 112 starts off positive delta. So on paper, right, in theory, we would expect the trade to make money when the underlying asset, S&P 500 in this example, is moving to the upside. But it's not the case. We have too many moving parts here. We have naked short puts, right, which should decay as the market moves higher. And then we have a kind of a built in a hedge for these naked puts, and that's our long put debit spread. And in this example here, this is a perfect example where we took this trade. It started off positive delta, market moved higher, but we're not really getting the reward for the risk that we're taking. Why? And that is happening because as volatility continues to contract, the value of our put debit spread is decreasing faster than the value of our short naked puts. And that kind of creates a net positive effect on Vega, right? So I don't want to go too deep on the second order Greeks, but if you are in the position where you think you need to add more positive delta to your portfolio, do not look at trades like 112 that start off positive delta as a solution. It is wrong because in times like what we're seeing right now, where the market continues to rally, but volatility is acting a little different than what we would normally expect, right? You're not going to get the reward for the risk that you are taking with the capital that you're putting behind these trades. Make no mistake. I mean, I'm not here to tell you that this trade doesn't work. It will work out one way or another. It's going to be sooner or later, because what's going to happen is, right, in this trade example, we have 84 days. And if the market continues higher and it could take longer, we're still going to make our max potential reward or the tail profit. It's just going to take a lot longer. If you wanted to add more delta to your positions because your overall or your net Greeks are telling you that you need more positive delta, you have to look at raw delta. Maybe you're buying SPY, right? Maybe you're buying shares. Maybe you're just shorting um, closer at the money puts to give you more positive delta. But a trade like a 112 is not really the solution that you want to look at to add more positive delta to your portfolio when your net Greeks are telling you so. And I did see some questions, and we had discussions about, what is happening right now? Why is the market moving higher, but our net positive delta 112 trades are really not getting the results we would expect to see? And this is very simple because the value of our put debit spread has fallen faster than the value of our um, naked short puts. At some point in the future, over the next, maybe 30 days, now we can look at this trade, 30 days into the future. So let's look at T plus 32. We can see that, right, the market is expected to move down to about 472 on the XSP or up to 504. In any case, we don't have any risk here. So whatever is going to happen, it's going to happen. And we have really no concern about it. In the end, we go all the way out to, T plus 82 at expiration. If we move down one expected move to the downside, we're going to tag the trap, which is going to be really nice. If we move down 2 standard deviations, this trade is really going to pay off because we're going to hit the trap. And if we move to the upside, we're just going to capture the tail profit or the initial credit that we took upon entry in this trade. And now I'm going to just reset it. And again, after 17 days being in the trade, we took in about, $890 up front. With 84 days, I mean, there's a lot of time left on the clock. So, and this is one of the reasons why this trade is really not as profitable as you would think it would be, because there's a lot of time on the clock. And even though the market has moved up, the value of the naked short puts, it held up relative to the value of the put debit spread. And it's just a function of volatility, decay over time, and price. And it's something that we can't control, but something that we definitely need to be aware of. So that's April 19th. We go forward to April 30th. Again, very similar situation here, right? And this is the reason why we were talking about this just a couple of days ago, that, we put on trades that are positive delta. We would expect to see a lot more profits, but we aren't. And, I don't want to repeat myself, but we're seeing exact same thing. The value of our long options or our long position, which is the put debit spread, has fallen faster than the value of our naked short options. And that's kind of holding up the gains. And I think that it's going to take maybe a couple of weeks. Once we get past next week's Fed meeting and volatility is going to kind of level out a little bit, we may see accelerated profits, but that's yet to be seen. Next and last for the PM account is the 17th of May position, and this one also 10 days in the trade, market moved 1.5 standard deviations to the upside. Really nothing to do here. We're just kind of hanging out here, going up and down until we really start to push into the trap. And there's a lot of time. 112 days is a lot of time. And if we start to really roll over for whatever reason, we need to start to get a little bit more concerned about this trade. For right now, there's really nothing to even think about, nothing to look at. And that's the goal. I just said that, we are, our goal is, or we're trying to build a portfolio of trades that don't require, day-to-day babysitting. We don't need to look at trades a couple of times a day. You put this on, you know that until the market goes down at least, 5 or 6% from where you took the trade, you don't have to think about it. You go on about, living your life, doing things you enjoy. You don't have to babysit these trades. And I think this 112 trade setup is a very, very good trade to um, implement if you are looking for less stress in your trading. And that's exactly what we're seeing right now. So that's and then one other thing that I do is I look at all of my trades as one. And it's not a clear picture because, it kind of looks ugly down here, -8%. But again, some of the trades that I have that have less time until expiration, they're really going to pay off. Some of the trades that are further away in time from expiration, such as the May 17th, they might get into a little bit of trouble if we pull back 8%. So this graph here is not really telling us the true story, but you know, overall, what I'm looking at here is my net Greeks, and you can see that between all of my XSP positions, I'm net positive 58 delta, which is fine, right? Market is in a uptrend, or at least that's what it looks like to me. So I'm okay being net positive delta, have net positive theta. That means every passing day, we would expect, the net value of our options to decrease in price, which is positive for us. And Vega here is also a player. And if Vega starts to increase on the way down, that's going to change things. It's going to push the T+0 line lower. But overall, if we're just kind of chopping back and forth, if we stay within, -4% to +4%, odds are we're just going to capture a bunch of tail profits that we have in these positions, and I'm totally fine. It's going to be a little slower than what I would like. And as we know that when the market starts to move both ways, up and down, if we are seeing, 5, 7, 10% pullbacks every couple of months, these 112 trades are really going to pay off. If we're going to continue to move, within the 4-5% range, down 4%, up 4%, we're probably just going to capture tail profit, and I'm totally fine with that as well. So that's for the PM account. I'm gonna look at the and I'm gonna change my screen here real quick. So now what we are seeing, this is the span margin where I use ES to structure my 112 trades. I have one other trade. I have one trade with Tasty Trade, and the rest are with TD. Again, I don't think I have any preference with Tasty over TD, other than TD allows me to send 112 order as one order instead of breaking up the order into a put debit spread and then naked short puts with Tasty. So these are the positions that I have on right now in ES. And you can see that in this spreadsheet, I have the nearest expiration is 49 days away. So these trades are very slow. It's going to take a little bit of time for these trades to start to come off. And as we progress, over the next 2 months, there are going to be a lot more activity as some of the older trades are coming off and some of the newer trades are coming on. So we'll get the excitement. But for right now, I keep adding trades. I try to do it at least once a week. I try to not put on trades that have strikes overlapping. I try to keep trades in different expirations. But again, with ES, if you look at, available expirations, there are only so many. So we can choose to either go a little bit higher in um, the size of the trade in any given expiration, or in my case, I don't want to put on a trade, let's say in 49 DTE, or this is what's left, right? So when I took, let's say, this trade here, 2778, when I took the trade, it had 88 days. And then the next trade that I took in the same expiration cycle had 52 days. They both have 49 days to go, right? So both trades are in the same expiration cycle, except I initiated one trade with 88 days to go, and then I was looking for a new trade, and then I decided to use the same expiration cycle that only had 52 days, and that gives me a little bit of a diversification, if you will, over price rather than over different assets. As you can see, I'm only using ES for these 112s. And you can also see that when I took the trade with 88 days to go, my strikes were 4650, 4600. I took another 112 in the same expiration cycle, but with about 30 days less, my strikes were significantly different, right? So I have some put debit spreads at 4650, 4600, and then I have in the same expiration cycle, I have 4820, 4770. So if the market starts to roll over, I know that this trade, 2801, is going to get into trouble first. So I'm always aware of, where the risk is. And I don't mind putting on another 112 in the same expiration cycle. I just don't want my strikes to overlap. I hope that makes sense. So I'm going to, let's give it a second. I'm going to switch over to Option Explorer, and we're going to go through some of these ES 112s and kind of show you what these trades look like. You are going to find, so we have the first one is the it's a 49 DTE. I'm going to switch screens once again to my Option Explorer screen. And that's what you should be seeing right now. With this trade was taken 39 days ago. ES moved up 0.82 standard deviations. And we could look at a chart just to kind of get an idea about what's happening here, right? We took the trade, market kind of drifted higher, pulled back to the 21 EMA, and we're just continuing to the upside. Not much is going on here. I did make one adjustment in this trade. And again, if you are, when I say I made an adjustment and you're saying, well, what was the adjustment? This trade ID is 2778. If you go on Discord and you punch in 2778 in the search bar, right, this is going to bring up the trade. All the trade details are in there. Every adjustment that I make along the way gets posted in there. So you should be able to see what I did when I did it. And then if you have some follow-up questions pertaining to that specific trade, you should be able to post a reply and I will respond back to answer your questions. But in this trade, what I did was I rolled my long leg And, we can kind of go back and see. This was on January 10th, and the market was trading at around 48, I don't know, let's call it 48.12. So somewhere down here, right? As the market was pulling back a little bit, and what I ended up doing, I mean, I know that the best or the outcome most likely, this trade is going to expire in the tail if the market continues higher. So here we're just kind of moving sideways, right? So the first green dot is when I took the trade, and then we were here on the second green dot, right? So the market pulled back a little bit, and now we're picking back up. So I'm thinking that, well, maybe we won't hit the trap. So what I'm going to do is I'm going to um, reduce the width of the spread of the put debit spread. So initially this was a 50 wide, and I rolled the 46.50 down to 46.25 for a credit, and I used some of that credit to buy back one of the short puts at 38.25. What this adjustment did was I gave up some of the potential reward inside the trap. Okay. I also slightly increased my potential reward in the tail, which is okay. That's fine. And I also unlocked some of the buying power that was tied up, because now I only have one short put at 38.25. Before I had two. So buying power was removed, and that allowed me to put on new trades, just recycling the buying power. There's really no secret sauce here. It's that simple. So every trade has two sides, right? There's the good and there's the bad. So what's the good? The good is that I took back some of the buying power. Awesome. What else is good? The good is that I had increased my potential reward in the tail. That's great, right? So that's good. What's the bad part? I gave up some of the potential reward inside the trap, right? So I kind of measure my um, the risk is that I'll make less if the market pulls back into the trap, but the reward is that I can recycle my buying power, and that if the market continues to run to the upside, I'll make a little bit more in the tail, right? So the risk to reward. And what drives my decision primarily is just looking at the odds. Again, just like I mentioned earlier today, we can look at the delta of the long leg of the put debit spread to kind of, you know, um, estimate what is the implied probability of the 46.25 put being in the money, right? That's where my long leg of the of this put debit spread is. 46.25 right now with 49 days to go is currently delta 13. What does that mean? There is an implied probability of this 46.25 put being in the money at about 13%, which means that there's about an 85% probability that 46.25 is going to be out of the money, which means that we're going to expire somewhere at 46.25 or higher over the next 49 days. So even today, if I had this trade on and I didn't do anything else to it, if I can roll back the 46.25 and collect the credit and use that to buy back, um, well, I can't buy back partially here because I only have one 38.25 left. But if you're trading a bigger size, you can kind of use that information to make a decision. Is it worth taking back some of that buying power? Because this trade only has about a 15% or maybe slightly less of being in the trap profit. So I might as well open some of that buying power and maybe use it for the next trade that could be 120 days away. I think that's really good use of capital instead of sitting here and kind of hoping that the market goes down. You don't want to align your directional outlook with what your positions may look like. You know, you just have to play the best you can, the hand that you're dealt, and everything else is um, you have no control over. So right here we have a position that has about an 85% implied probability of expiring in the tail. So if I can, take back some of the buying power and, I'm giving up some of that potential reward inside the trap, I'm totally fine with it. And that's exactly what I did with this trade just a couple of weeks ago. I think that's the only ES trade that I made an adjustment to. So we're going to go forward. This is a 112. Trade ID is 2782. This trade was opened 29 days ago. We can see that ES has moved about a half of one standard deviation. So not, nothing that wasn't priced in at the time when we took the trade. We can see that we're still in this nice uptrend. And if things continue, I'm just going to make the tail profit here. And if we do pull back 6% over the next 62 days, we have a chance of maybe making the trap profit. But again, let's go back and see, what are the odds of making the trap profit? Well, in order for us to make the bear trap profit, right? The 46.50, which is the short leg of our put debit spread, has to be in the money. What is the delta of the 46.50 put? It's about 15. What does that mean? Right? If the delta of the 46.50 is 15, this means that there is about a 15% probability that 46.50 will be in the money at expiration over the next 62 days. There's a 15% probability that 46.50 is going to be in the money, which also means that there's about an 85% chance that at expiration, 46.50 will be out of the money. And we can look at the long leg of the put debit spread, which is currently delta 17. Let's round this off to, make this delta 20. There's an 80% probability that this trade is going to expire for a tail profit, which is totally fine, right? We can't control the price. If you think that the market has a higher probability of going down, you can, take on new trades that are closer at the money, right? But you can't really do anything about this specific trade other than maybe if you think that the market is due for a pullback and you think that the market is going to do X, you can maybe close out one of the naked puts. And what is that going to do? Okay, let's see. If you close out one of the naked puts, you can see that we are, well, the first thing we're going to do is we're going to take back some of the buying power, which is great, right? Because you can recycle and use this for something that has maybe 120 days. So we extend duration and use this capital that you're going to free up for something else. That's awesome. What else? Well, that's one positive, and there are several negatives. The negative number one is that we're giving up some of that potential reward in the tail, and we're also giving up some of that potential reward in the trap. All right, so there's good and the bad. If you think that the odds of a pullback are higher than, again, and it all depends on the price level, right? If you're looking at 4,800, it doesn't really matter if the market pulls back to 4,800. This trade is really not going to do anything. But if you think the market is going to pull back down to about 4,800 in the next couple of weeks, then maybe that is going to drive your decision about your trades that you're going to put on going forward. instead of taking on a trade that's positive delta, maybe you'll start off with delta neutral, which is one of the trades that I took just recently, and this was one day ago. This was May 17th, and I'll talk about that when we get to it. Right, but for right now, I think that taking off one of the short naked puts, if you think the market's going to pull back, is really not a terrible idea. Yes, you are giving up some of that tail profit. You are sacrificing some of that trap profit, but what that is going to do is it's going to free up some of the buying power. And if you are right and the market does pull back, you're not going to get hammered on your buying power. So there's no right or wrong. It's just, you got to take the good and the bad and kind of weigh things in and see where you are in your trading. And, that's going to help you make a decision. I'm just going to leave this alone. I'm not proposing that, we go on taking off short puts because the market's going lower. And just looking at the chart here, regardless of what the market is doing today, there's nothing to suggest that, this market is rolling over or we're just barely pulling back to an 8 EMA. We're way above 21 EMA. So we can pull back as far as, 48.24 on the ES, which is, what's that? ES is at 49.10. And if we pull back down to 48.24, what's that? Like 90 points lower. It's going to feel like the sky is falling, but we're only going to pull back down to about 21 EMA. And we have tested 21 EMA on the 17th. We tested and held the same 21 EMA on January 4th. So in my opinion, this uptrend is still intact, and therefore there's really nothing to do just yet. We're just going to let things be and see how this plays out. We're going to go forward looking at the 19th of April, 24 days in. Again, similar situation, same story. I'm not going to repeat myself. Nothing to do until we really start to push back. And I think that for me, until we get down to about like 4,800 on the ES, nothing to do here. Like if you wanted to not look at your trades, if you wanted to take a couple of days off and not worry about the market, I would probably just set a price alert at ES at 4,800 until you ping me and say, hey, ES is at 4,800 or lower. There's really nothing to do with, doesn't matter how many of these 112s you have on. You have to kind of know where your, hey, I need a wake-up call. Let me know when the market is down below 4,800. Anything above that, I know that, with these kind of ES 112s, I'm going to make the tail perfectly fine. If we get down below 4,800, okay, now we're getting closer to the trap, still not in trouble, but now, if you have a lot of time on the clock, you may need to start to kind of, look at the trade and wonder what you may need to do, if anything. So I'm going to kind of skip through these trades just to show you what these trades look like as far as risk graphs go. They're all very similar looking. They're just spread out over different expirations and different strikes. And let's see. We are going to oh, sorry. I think I lost the sound here. We're going to move to the 17th. 7 days in the trade. Market moved 1.14 standard deviations. Not a whole lot going on. And for a trade like this, I probably wouldn't worry. Again, 4,800 is kind of like my line in the sand. Don't bother me with these trades until we're at 4,800 or lower. Could it happen next week? Maybe. Could it happen um, 2 weeks from now? Maybe. But 2 weeks from now is better than next week, right? The longer it takes to get down to a certain level, the better off we are. So for right now, these trades are on. They're working slowly, but they're working, and we're just going to let them do what they do. And here is a March 15th, which I took, and this is an interesting one. I took this trade 3 days ago, right? The market has moved about a half of one standard deviation. As you can see, my tail here is not as great as a normal or a typical 112. Let's say, let's just go back to uh, May 17th. See, the tail here is like $500 for one contract. And if we look at March 15th, right? So the May 17th has 112 days to go. March 15th has 49 days to go. So a lot less time, and the the less time we have until expiration, the more sensitive your positions become to price changes, right? That's a function of being short gamma. And here I took less money up front, but I'm playing for a bigger potential trap profit. So less time until expiration. And if the market is going to pull back 5% over the next, let's say, 30 days, we can compare the two trades, right? So if, let's say we move down 5% in 30 days, we can see that this trade on a 5% pullback, now we're inside the trap. And then if we look at something with 112 days, a 5% pullback in 30 days, right? It's still going to supposedly be a profitable trade. But with 80 days to go, odds are volatility is going to pick up, and T plus zero line isn't going to be as pretty as what we're seeing right now. T plus zero is going to be much slower. This trade is probably going to be barely breaking even. So the less time I have until expiration, the more directional I'm going to be with the trade. As you can see, that 5% pullback with only 17 days to go. Well, this trade is going to be really, really nice, right? Because with 17 days to go, and if we're down, 5%, maybe we're at 46.50, it's very likely, it's more likely that we're going to be inside the trap with 17 days to go than we are with 80 days to go. So when I took this trade 3 days ago, I am kind of playing for the downside. Is that what's going to happen? I have no idea, right? There's nothing here to tell me that, hey, market's going to go down. But if we do go down, I mean, eventually, we all know that, the market is going to have to retest the 8, the 21. Maybe we go down and test the 50-day moving average. We don't know that. But the less time I have until expiration, the more directionally I want to be exposed. So here, with 49 days to go, I don't want to have a whole bunch of positive delta, because the likelihood of the market pulling back over the next 49 days is a lot higher than it is over the next 80 days. Right? So here I took less credit up front, and guess what? If the market continues to move higher and I'm wrong in my assumption that the market might pull back, okay, what am I going to do? Am I going to lose money? No, right? Because they took a credit up front. So I'm not really concerned. I may not make the normal tail profit, which will be, $600 for one contract in this case. I'm going to make way less, and I'm totally fine with it. But if I am right, and if I think the market's pulling back and we actually get that, I have a very good chance of potentially catching price somewhere inside the bear trap over the next 49 days. And one more thing we're going to look at, this is, again, this is a slightly longer duration. This is 112 days. Again, I didn't take any credit up front. I did this trade for zero. I didn't pay anything. I didn't collect anything. So this trade was put on for zero. So if the market runs higher over the next 112 days, this trade stands to make nothing to the upside. And that's my risk of, um, opportunity loss, I guess. Right. I am using, I think this trade took up like $4,500 for one contract to put on. So I'm using up $4,500 worth of my buying power. I'm not really getting any reward if the market continues higher. But if we do pull back, and we can look at implied probability of market pulling back one standard deviation over the next 112 days. If we just move one standard deviation to the downside, I'm in the trap, totally fine. If we move two standard deviations over the next 112 days, I'm in the trap, totally fine. If we continue higher with this uptrend, well, then I have made nothing. So that's my downside. And all it took is about $4,500 or $4,200 worth of buying power to participate in this. All right, so that's the, and then let's look at all these trades combined. And this also could be a little bit misleading, but for the most part, right? Down 15%, or so anything 15% lower or higher, or 15% down or higher. So from here all the way down to about 15%, I'm going to make a profit somewhere in between. The market has to really start to move lower. And I can see that, combining all of these trades, my net delta, my net directional exposure to ES plus 2 delta. Right. And I can see that at 4,800, right, all of my positions combined, I'm probably going to be, maybe break even, maybe down a little bit. But again, I'm using this 4,800 as kind of a line in the sand right now. Anything above 4,800, I'm very unlikely to do anything as far as adjustments. And if we get down to 4,800, I may start to kind of look at each individual position, what it needs to do. The less time we have until expiration, the more attention this position might need. The more time we have, the less attention this position requires. So that's kind of my thought process. And these are the positions that I am holding right now. I hope this guys gave you a little bit of a insight as to, how I look at and what I think about when I look at these positions. I'm going to spend a couple of minutes just going through some of the questions. I know that Candy is very active responding to questions in the chat. Let's see. Yeah, Candy's doing a great job, answering most of these questions. Some of the questions are about things that we had covered just recently. XSP being used because it applies more to, and that's Mark saying that, yes, I do use XSP because I think it's more actionable for an average member in our community. Not everybody can trade SPX 112s, but whether it's SPX or XSP, or you may be using MES or ES, the price levels are relatively similar. So either or can work. It all depends, how much buying power you have available, how much risk you're willing to take for every trade that you take. So I'm using XSP for the PM account, and this is a kind of a quote unquote starter PM account. It's 100 and or it started at 125,000, and all I am doing with this starter PM account is I am trading XSP 112s, and I am buying treasury bills that are 13 and 26 weeks, and I just keep rolling one into the other. And as I said in our last Zoom, when we talked about the difference or the goals or the plan for these PM and the span, is that I'm kind of running, and some of these trades are very lookalike, right? There could be in the same expiration cycle. The strikes may be very similar. I'm running both side by side, and the results over the next 3, 6, 12 months is going to kind of dictate and tell me, if smaller PM accounts are better off trading ES options in span instead of going with PM account. I think PM accounts are great for accounts that are a million plus. If you're not there, and if you're looking to do trades within maybe a $500,000 account, is it better to go PM or is it to go span? I don't know just yet. We are going to find that out, and I'm going to let you guys know what I find. So I think that's going to be pretty interesting. Another question: when doing 112, how do you decide if you're going to do a 60, 90, or 120 DTE? That's a great question. And the main driver between 60, 90, or 120, even if you are using very similar setups, not same strikes, but similar setups, meaning that you're going to go with a 50-point wide put debit spread financed by a sale of two out of the money naked puts for a net credit of, let's say, $10. Right, that's kind of like my standard 112 setup. If you're just looking for exact same setup over 3 different durations, 60, 90, and 120, you will notice that going out to 120 DTE, you will position all of your strikes a lot further out of the money, right? So you're giving yourself more room, or you're giving yourself a little bit more time to be right. That's one. And number two, options that are longer in duration will typically require less margin up front. So that's the difference. So as I said earlier, the less time you have until expiration, the more right you have to be on direction, right? If you initiate a trade with, let's say, 20 DTE, like a 112 that starts off delta positive and all those good things that we look for,
Man,
and the market pulls back on you with 20 DTE, you only have so much time to be right. So your 20 DTE position is going to be a lot more sensitive to price near term than similar trade with 120 days until expiration. So the difference between 60, 90, and 120 is just how sensitive you want your positions to be to price change. And I think that's, and then buying power is like secondary. But I think that the more days until expiration, the less sensitive your positions are, the more relaxed you can be with your trades. Another question: do I use technical analysis when entering trades? I try not to, right? Sure, I will look at a chart and kind of see if my trade or my net Greeks would align with my near-term outlook. But if I'm doing a trade that's 120 DTE, who cares what I think about the market in the next 2 weeks? Right. Or maybe if I think the market is extremely overbought, do I want to put on the trade that starts off net positive delta and is very bullish in nature? Probably not. So maybe I'll start off with slightly neutral delta, as what you are currently seeing on the screen, right? So my outlook is maybe not as bullish near term, but this trade has 112 days. a lot can happen. What's going to happen is in the next 2 weeks, if the market continues to rally, maybe if my near-term outlook changes, I may need to make some adjustments. Maybe I'll roll down uh, the long leg of my put debit spread. Mm, maybe I'll just instead leave this trade alone and add new trades that are going to start off a little more bullish. But that's yet to be seen. I mean, this is what my near-term outlook, and I do use my technical analysis to kind of dictate how I want my trade to start. Let's see. Spreadsheet in the last year, how often has the put debit spread entered the trap? That's a great question too. In the last year, and I think I posted results for last year for 112s using SPX, and results were really great, but they weren't as great as they were in 2022. In 2022, market was two-sided market. We had a number of short-term pullbacks, like 7, 10, 12, 15% pullbacks. Last year, I think we only had like maybe 3 pullbacks to the tune of maybe 10%. So last year, market wasn't as reverting as it was in 2022. So 2022 was a really great year for trades like 112. We didn't have any black swans, which is great, but we definitely had some deep pullbacks. And as Tom had a killer year, and 112s really paid off in 2022. Let's see, one more. Given the premium versus margin requirement, how do you use XSP versus ES? I think that this is a question that we could probably spend an hour going over and trying to answer this question, but and we'll do a Zoom where I'll dive in a little bit more into how to, or at least what I use to properly size the trade according to account size, right? I don't really look at the premium up front versus the buying power that is required to put this trade on, because that could be a little bit misleading. Again, using ES has a lot more leverage, so your entry is a lot lower. It takes a lot less dollars to put the trade on, but you always have to use some kind of either the notional value of the contract that you're selling naked to dictate how much risk you want to take, right? Because if it only takes, let's say I'm going to put some random numbers. If it only takes $1,000 to take $100,000 worth of risk, and you have 10 grand in your account, you can leverage to the hills, but you're also spreading yourself so thin that you have no room for the downside. So instead, I look at, where's my stop? Like, for example, this trade I have here, if I know that the most I can make is $2,500 in the trap, am I going to risk 10 grand on this trade? No, right? Even though 10,000 is not that far. I mean, the market does have to go, down 20%, but am I going to risk $10,000 knowing that the best case, if the market pulls back and everything works out perfectly, I'm going to make $2,500? No, I'm not going to risk 4 perfect trades, right? As my stop loss. For me, and again, this doesn't have to apply to you. You can use whatever metric you use, but for me, I gauge my stop losses based on what is the max I can possibly make inside the trap, and this is given that everything works out perfectly. If I'm going to make $2,500 in the trap, I don't want to lose more than $2,500 if things go really wrong. Another way to do it, and we'll get to this in the future, looking back at your results, right? Look back at, what have you done with 112s in the last year, 2, 3, 5 years? What's your average winner like, right? If your average winner is 5K, whatever your size of the trade is, if your average winner is 5,000, are you going to risk 20K on any given trade? No, you don't want to take a 4x loser on a losing trade. Even if you have, a super high win rate, you don't want to, put yourself in a position where it takes 4 or 5 trades to get back one, right? So um, you have to use the proper metric to kind of decide um, how big of a trade you have to take, and using um, credits that you're collecting up front relative to how much buying power it takes. In my opinion, it's slightly misleading and maybe wrong altogether. But to each his own. Mark is saying, why does sometimes T plus zero line go above the trap line? Mark, I think we talked about this, but just to for example, here, right? We go forward 32 days. You can see the T plus zero is way above the T plus at expiration line. And that's because 32 days into the future, the value of this put debit spread is going to be higher than what it is at expiration. At expiration, just if we are where we are today, right, let's call this 49.70. At expiration, 49.70, right? The mark is at 49.70. At expiration, 4,900, 48.50 is worth nothing. And that's what you're seeing down here. But 32 days into the future, with 80 days to go, this 4,900, 48.50 is going to have value. It's going to have the time value. And that's why you're seeing the T plus zero line way above than what it is at expiration, which is a great trade all by itself, just to play for this. You call it the hump, or right. You're anticipating the T plus zero line to rise ahead of expiration, and it's actually the opposite of what we're seeing right now. All right, check this. That's not a good example. There's a few examples of these trades. Like, for example, here, right? We have 49 days to go. You would expect, right? If everything what I just said was true, right? The value of the put debit spread is increasing and it's worth, the 49 days worth of time. But we see that, check this out. You see that the T plus zero line is bent kind of downwards, right? This is like this is really weird, and it technically shouldn't happen, but that's what it shows up in these pricing models, and that's because the value of this put debit spread is actually getting hammered. Instead of retaining or maintaining its value with 49 days to go, the value of this put is getting hit harder than the value of these naked puts. So that creates like this net negative effect, which causes the T plus zero line to dive. Doesn't happen all the time. It happens it only happens, or at least I have noticed that this happens mostly during hard, fast, relentless rallies when volatility is falling. Let's see, a few more. What do you normally do when it starts to get into trouble? So normally, and you can go to the YouTube channel where I post videos, and you can see that I have a video out there, and you can probably search within the Discord delta hedging. It'll show you links to uh, different videos that we might have posted in the past. But I the idea is, once or when the market starts to push lower and our T plus zero really starts to dive, the goal is to either hold and pray that we don't hit our stop on the way down, or you can do something to flatten out this T plus zero line. You can buy some put debit spreads, you can buy some naked puts, and so on. Let's see. We'll give an example. If the market went down to 4,800, what we should do. Again, it all depends, right? There's a lot of moving parts here, guys. If you are looking at something with 49 days to go at 4,800, you don't really have to do anything. Why? Because you're delta neutral, right? You don't really have much to do at 4,800. Sorry, let me go back. We're using 4,800 as an example, right? So at 4,800 here, with 49 days to go, do I really need to do something? Not really. How about if we go, oops, maybe 112 at 4,800? Nah, we're still not really in trouble, right? We're still delta neutral, but we're starting to, the slope or the curvature of this T plus zero line is really starting to pick up. We go down to 4,600, you can see that we're really starting to slide down the T plus zero line. That's when you have to activate and do something maybe if you were to mitigate some of the losses. Question about T-bills. Not going to touch that right now. We can talk about T-bills at another time. Also, Ed has done a tremendous job posting things on T-bills. Do check out Fixed Income channel on Discord. There's a lot of information there, so that should answer a lot of your questions. Last question, and then we're going to jump. I don't understand, and this is Jerry saying, I don't understand why strangles are trades talked about all the time. However, 112 strangles are not. Man, we're going to be here until 6 p.m. So this is a great question, and we could talk about this for hours. But the idea is that 112 strangles, and if I am understanding this correctly, 112 strangle is a 112 with short naked calls. The short answer is short naked calls will get you into a lot of trouble very, very fast, especially in the markets like this. If you have Optionet Explorer or any other kind of back testing tool, go and try to do a 112 November 9th of last year and let me know how this works out today. Odds are you're stopped out or you're in massive house of pain. I think selling upside calls only works even here, right? End of the year last year, you would say, oh my God, the market is so oversold, MACD's crossing over, RSI's, blah, 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 whatever. If you sold a bunch of calls here, guess what? You're biting your nails right now, right? So I don't think it's a good idea to just, sell naked calls to juice up your 112s. It's a terrible idea. You're going to blow yourself up. Okay. What I meant is selling a call and that's just, it's very similar. Naked calls or 112s to the upside, they just don't work. They don't work. Why? Because in a normal volatility environment where the IV for out of the money calls is way lower than IV for out of the money puts, right? Which is called, the equity skew, right? Implied volatility for the calls is lower than implied volatility for the puts. You just don't get enough juice to the upside. You can't go far out enough, right? To compensate or to make the risk worth the reward. So here we have, or at least when I took this trade, for example, we have a bunch of premium in the puts where I can place my put, maybe 25% out of the money. Look at your calls, 25% out of the money. They're worth nothing. They're worth pennies, right? So what are you going to sell there? There's nothing to sell. So that's why I think upside 112s don't really make a lot of sense. All right. So I'm going to wrap this up here, guys. I apologize for taking this long to go through all this stuff. Hopefully you found this useful. And if you have any questions, where to find me. We're always on Discord. We have a bunch of different channels, different forums. You can post your questions, and we will catch you in the next one. Have a good weekend, everybody. Bye-bye. Bye-bye.